Hey there, it's Marconi White. And did you hear that the Bitcoin ETFs lost over $1 billion in 8 days? I mean, what a failure. It seems the institutions never arrived. The boomers aren't buying. At least that's the narrative making the rounds, but I don't think that's the entire story. ETFs are a test of adoption. Any criticism needs to accurately measure if they've succeeded on that front. And believe it or not, the data may suggest the biggest adoption is already happening. So let's review how successful the ETFs have been to date, look at the data points behind institutional buying, and discuss why institutional adoption might not be needed in the end. But first, we're going to look at the flows. So the Bitcoin ETFs launched January 11th, 2024, and quickly became some of the best performing ETFs of the year. And just 2 months later, on March 11th, we have a tweet here from Aaron Balkanis talking specifically about that. He says 2 of the ETFs, IBIT, BlackRock's offering, and FBTC Fidelity's offering, are ranked 3 and 4 in the top 10 for flows for March across all ETFs. And I think part of this, other part of this Twitter thread, he talks about the fact that maybe some of this could have been expected 6 to 9 months or even a year in. But to come as early as it did, it's just incredible. So already, in March, we were talking about how successful these were being. Now you fast forward a little bit, take it all the way to August, and you experienced over 17 billion in inflow. And I want to show you this next slide. This is an image that comes from Farsight Investors. They maintain about a 2-week rolling average or rolling schedule of the actual inflows for each of the ETFs. You can see here on the bottom, it actually has the inflows coming into IBIT, FBTC, IBIT having about 20 billion. And if you go all the way to the right, you can see GBTC, Grayscale, which had a head race, right? Started with a larger number. It's seen 20 billion in outflow. Even with that said, you have just around 17 billion of inflow for the year. And this includes the weeks that we talked about, that $1 billion that came out in the 8 days in September. So, I mean, under any measure, we're talking about 17 billions of dollars. It's a lot of money. So now we're in crypto. A lot of people think to themselves, well, 17 billion, that's not a lot. Well, you need to put the context in to what the expectations were going into the ETF launch. You see, a lot of people have been talking about the institutional launch or the ETF launch for a long, long time, years, in fact. And you had the skeptics who saying it wasn't going to do well at all. And then at the beginning, before it even launched, you had people starting to talk about what those numbers would actually look like. And Benjamin, on a recent episode of Trading Pit, he actually explained what the expectations look like. Let's take a look at that clip to hear what people were actually thinking before these actually went live.
So the whole expectation when BlackRock filed for the ETFs, the 2024 expectation, even from Eric and a lot of prime brokerages, almost the majority of the OTC desks, Coinbase, all included, the expectation was 24 billion on a hyper optimistic upper limit, actually. So that was supposed to be end of 2024. That was the expectation, that in a period of 12 months, we may hit 24 billion in net inflows if all goes great.
So for a full year, what they were looking for was 24 billion. Now we're in August, and actually the table I just shared here, it's actually in September, you have 17 billion, which is roughly about 70% of the highest expectation. Just to give you a little bit more perspective on what this might mean, if you look down here, the average inflow is about 101 million per trading day. If you take that and look at the remainder of the year, if that continued, that'd be about 11 billion, which would net out to about 28 billion, exceeding the highest watermark that they had by 4 billion. I think by those measures, you'd have to say that these ETFs have been a success from an adoption perspective. But to be fair, a lot of the discussion isn't just about flows. It's a question of who's actually buying these ETFs. And that's where a lot of the criticism has come from. They're saying, are the institutions actually buying? Well, now, according to Jim Bianco of Bianco Macro Research, the answer is no. See, after the $1.2 billion redemptions that came out in September, the ones that you're seeing right here on the screen. Hey, Marconi here. I need your help to win a bet with Ben Lilly. He said the interest in crypto is so low that JLabs Digital could offer Jay, the personal AA trader, for free. And people still wouldn't take the 5 minutes to give it a try. I said, you are crazy, and I'll prove you wrong. So all you got to do is click the link here and sign up for Jay, and Ben loses, and he has to drink Earl Grey tea for an entire year with no espresso. And if you're wondering, what's Jay? Well, it's the AI software that's been used to power funds, trade desk, and over 9 figures of capital in some of the most extreme conditions in crypto. And now it's tuned to have one job: use lower risk trading strategies to consistently grow your account over time. And here's the best part. Jay does the trading so you can be in crypto without living crypto. You get to sleep, touch grass, and spend time with friends and family. Sounds perfect, right? Well, click the link here to get started. Let's get back to the show. Jim put out this tweet, which was I think about 8 different tweets, actually trying to summarize or detail the points he was making, that these ETFs have been, for lack of a better term, a non-success. They've been a failure on the front of actually getting institutional adoption. He says it's not an adoption vehicle. Instead, a small tourist tool, and on-chain is returning to TradFi. So he's calling $17 billion in flows a tourist tool, but we're going to dismiss that for a moment. I want to go through the 4 points he notes here, which summarize all 8 of his tweets. It says inflows are now outflows. Yep, you're going to see the outflows. Agree with that. Hodlers have recorded losses. Well, yeah, that's true, but anybody who buys an ETF and then sees the price decline is going to have unrealized losses on that asset. That applies to any asset, not just Bitcoin. You can dismiss that. Advisors are less than 10% of the holdings, and the average trade size is now 12,000. These are interesting points that we can actually get into. Let's actually understand, does this support his point that no institutions have arrived and it's just a small tourist tool? Let's get into it. So the first, I want to actually start with his discussion on, let me bring this up. All right, the discussion that he has here about small purchases. So what he's done here is he's got a chart. He has several different ETFs on here, including the SPY, the Triple Q, and what I think is the most relevant, which is a gold ETF, GLD. The y-axis that we see here, these are actually trade amounts and the average trade amount, and then this is over a period of time. So you see the larger ETFs, you've got SPY, you got the Triple Q. Then the middle part, you actually have the gold one, which actually is in gold. And on the bottom, you see Bitcoin. So he's absolutely right. Very much smaller amounts being applied to Bitcoin on a fairly consistent basis. We're seeing consistent purchasing and not a lot of variation on the actual amounts that are coming into the ETFs. And definitely much smaller when you compare it to some of these other ETFs. I mean, if you look at gold comes at about 60K per trade, whereas the Bitcoin ETFs are about 12,000. That's about a 5x difference. But then you should ask the question, is that the whole story? Not entirely. When you actually look at some of the other metrics around these ETFs, Bitcoin, or at least IBIT versus gold, actually stacks up pretty well. I mean, if you look at volume here, you've got 26 million in daily share volume for IBIT versus only 6 million for GLD. And the daily dollar volume for IBIT is sitting at just under $1 billion, whereas GLD is over 1.4, roughly 1.4. So it's definitely smaller, but it's not as if it's a 5x difference or a 10x difference. Bear in mind, GLD is about 20 years old and IBIT's got about 8 months. So here, Jim is definitely pointing out a correct statistic, but he's not giving a full part of the story to try and really talk to you about, are these people really buying these? Are they really retail people? And does this actually say that there's no adoption? I think there is adoption, but it's fair enough. It's actually smaller purchases. Whether these are serious buyers or not, time will tell. But let's actually get into the next part that he's actually going into, which is, are the institutions actually coming? And here, I think he actually has a better argument that actually, again, has a few holes in it. So what he does, he's got a chart here, which I believe is going to be coming from, it's some reporting. Maybe it's coming from a Bloomberg terminal. But what it actually shows is for IBIT, which I've included here. He also does it, I believe, for Fidelity and for Grayscale. It does a breakdown of the institution types that actually own the ETF. And here he has the hedge fund managers, which own about 8%, investment advisors is 7%, brokers is 2%, and all the others are a very, very small number. The middle column is actual shares, and then the percentage ownership is going to be the outstanding shares, the total shares outstanding. So Jim looks at this and says, listen, you don't have any investment advisors. It's only 7%, 8% going to hedge funds, and they're more doing speculation. and brokerages only being nothing. And we got, maybe 10% if you calculate all the other institution types owning this. Well, there's an interesting point of rebuttal here, which is, yes, this is only 7% going to institutions, but how valuable is it to the marketplace? And here, Matt Haugen, the CIO of Bitwise, put some context around this. You see, he points out that the amount that's actually gone in from an investment advisor's perspective specifically equals about $1.45 billion. And that $1.45 billion, if you look at all the ETFs launched in 2024, it's actually the second largest amount going to investment advisors, beaten out by just one ETF that he notes here, which is KLMT. So you actually have quite a bit going into investment advisors when you compare IBIT to the other ETFs that are out there. But there's actually more to the diversity story, and this comes in from a tweet, again, from Eric Balkanis, the a senior ETF analyst at Bloomberg. He points out that, in his own words, the ETFs are a freak of nature when it comes to ownership. And this is a tweet he put out just in September 9th. Bitcoin ETFs collectively have over 1,000 institutional holders. IBIT specifically has 661 holders. Well, how unique is that? Well, if you compare it to the other ETFs that launch within a given year, it's not uncommon for them to have just 2 holders, which he notes here. You have 661 holders of IBIT versus 2 for the common ETF. And again, the whole conversation here is about adoption and whether or not the institutions are buying it. Well, it's important to note that you have 661 holders of these ETFs, maybe in very small amounts, but they are holding something. So when Jim's saying that there's no adoption from an institution perspective, he's not really adding that context, and I think that's important. 2 more points here. When we talk about the allocation, many people will say this is a high-risk asset, very volatile, at least based on historic parameters. Therefore, you should allocate a very small amount to it, 1% to 2% of a portfolio. This can lead to much smaller average purchase amounts, right? And we're still getting up to speed. Again, we're still in the 8 months here. So while Jim does have a point that it's not as if we have 50% adoption by institutions of these assets, I think he's not giving a full picture of the actual institution adoption. But what about from a retail perspective? Because I think this is the actual story that's not getting any airtime at all. And it needs to. Because what we're really seeing here is that normies are buying Bitcoin in the billions. So if you do, back of the napkin calculations, you got 17 billion in flows that have come in, divided by 12,000, the average trade, that's 1.4 million. Is that 1.4 million individuals that have come into Bitcoin? I don't think so. It probably needs to be discounted, people buying multiple trades. But how much of that is an individual buyer? Did it onboard 300,000, 500,000, even 100,000? That's a significant number of retail people that are coming into the ecosystem. And the point is that why are they coming into the ecosystem now rather than not doing it before? Well, we actually have an explanation for this. And this, again, comes from Benjamin on a recent episode of Trading Pit where he explains how his uncle actually bought the ETF. And so let's have a look at that clip.
Now, a lot of these guys are starting to buy the ETF. I know this because my uncle bought a Bitcoin ETF.
The uncle trade.
He has not for years.
Yeah.
We were neighbors. He never bought a piece of Bitcoin, but he's bought a Bitcoin ETF at 58K, right? Maybe he's wrong, but that doesn't matter. He says it's a long-term hold now for him. Mm-hmm. Why? The impression that the ETF vehicles have given him. Look, you can get it and you can put it in your brokerage account. You can keep it. Don't worry about the custody. And if you die, it can, go to your kids. Don't worry about it. So that opens up a very different door.
What Benjamin's really pointing at is that these ETFs are giving people that were Bitcoin curious a way to get into the market. They weren't willing to cross the technical chasm to understand seed phrases, to understand, how to manage this from a custody perspective. What happens if you die and you need to pass it on to people? They didn't want to do that. But once it's in their brokerage account and they can simply hit buy from an ETF perspective, they're in. So we're now opening up Bitcoin to an entire class of people. And I think you could call it the institutional Bitcoin is being adopted, right? adoption is actually happening. And by focusing just on the institutions, we're missing the broader point, which is that more people are getting into the ecosystem. Now, what does this look like going forward? Great question. Listen, the story isn't over, and Jim may be proven right in the coming months or years if the flow is slow or the trends reverse and the momentum of early 2024 comes to a close. And I don't know, it's possible that some of the bullishness in 2024 is all because they're expecting a bull run in 2024 and 2025. And if that doesn't materialize, they run to the hills. That's possible, right? But from right now, looking at the data as we have, I think it's pretty hard to argue that we're not seeing actual material adoption of Bitcoin, be it, the tourist people, as Jim calling it, that are just going to come and wait and see how well it does, be it the people who call it just fake Bitcoin or what I'm calling institutional Bitcoin. You have buyers, they're coming in, their uncles, their aunts, maybe even grandmas, I don't know. But adoption is actually happening. And I want to leave you with one final perspective on this that I think may be valuable and heartening to any of those who are really interested in decentralization. The real threat to these ETFs and their performance may at some point come from better on-chain experiences and self-custody. See, in a recent interview with Isabel Fox and Duke, we discussed the potential for ordinals, ruins, BRC20, and a host of L2s for Bitcoin, such as the ART network, that can radically enhance what Bitcoin can deliver from what it does today, really giving us some level of programmability, which to date, has only been available on other L1s such as Ethereum and Solana. And while it's still early days and it's all very speculative, these projects might actually deliver better UX experiences, the kind of experiences that finally eliminate the technical hurdles and offer DeFi and other capabilities that exceed what TradFi can do today. And at that point, it may be too expensive to actually hold your Bitcoin with the ETFs. And then we won't really care about the institutions, will we? All right, well, time will tell. I suggest you subscribe to the channel as we bring on guests, and we bring on these ideas. We talk about them every week, discuss them and other projects that are going to be relevant to the continual adoption in this space. But for now, this is Marconi White. See you next time.